Welcome to the latest edition of Structured Finance Conversations. I'm Susanne Matern, Head of EMEA Structured Finance, and today I'm joined by Kate Lin, a Senior Director in our EMEA Structured Credit team. We are going to discuss trends we see in the CLO market. Welcome, Kate, and let's discuss the market dynamics we have seen. It looks like 2025 will see another record issuance year after just 2024. Having seen record issuance, so what are the drivers behind that, and do you expect this to continue?
Yeah, that is correct. This year, we expect the issuance to surpass 2024 last year. So it's another record year, which is quite unusual. But because of the reduction in the weighted average cost of capital, so the market in terms of new issuance and also reset, it has been very active. Let's take a look at the statistic. As of year to date, we already have 74 reset, and this already exceeded 73 in 2024. And for new issuance, we have 94, which is against 114 last year. But consider the very active pipeline with 120 to 130 open warehouses and strong, healthy investor demand. We do expect that 2025 to definitely exceed 24 volume. So in terms of the reason for this very active market, so as I mentioned that as the ECB, they cut rates since last year, June last year to June this year, the weighted average cost of capital for the liability structure also has decreased significantly as well. And because of that, we have seen a lot of reset from the vintage that closed in 2023 and also the quarter one of 2024 as well, as they exit the non-core period, which is typically 1 to 1.5 to 2 years. Then the manager actually reset the transaction, and the AAA spread level for this transaction before reset was on average about 40 basis points higher than what we currently see at around 130 basis points. So for new issuance, so it is an interesting story to see the source of asset because to give you some statistic, in 2024, we have seen that the asset under management for the CLO portfolio has actually increased around 50% relative to the new issuance. So these 50% growth usually are coming from company refinance, or they just have a add-on tap more refinancing during the extension of the maturity or during the reissuance. And therefore, the remaining 50% estimated they are from the collateral from transaction that is amortizing, or the manager actually call the entire transaction and liquidate it. So therefore, that contribute the other roughly 50%. And given that the leverage buyout market is still quite limited, so and then also the refinancing condition has improved as well. So we believe that this trend will continue for remaining of 2025 and also next year as well. So as whether this will continue to 2026, whether 2026 will be a record year, then the third year in a row, it is really unprecedented. So I think it will depend on the dynamics between the weighted average cost of capital and also the loan repricing activities. Because we have seen a trend of the loan repricing with the asset spread coming down as well. As the ECB cut rate since June last year, if the weighted average cost of capital moves in tandem with the loan portfolio spread, then we still expect steady issuance from the new issue. As for reset, if they keep at current spread level, we will still see some reset from 2024 vintage when they exit the non-core period. But in the vintage in Q4 last year, the spread is not that much higher than current level, or maybe somewhat similar. So which means that if we want to see again very active reset like this year, then it would depend on whether the weighted average cost of capital continue to tighten. If that's the case, or the equity holder demand a lower equity, or somehow the asset pricing widen, which creates better arbitrage, then then it will drive growth in both reset and also new issues.
Oh, thank you. Now, you mentioned twice, I guess, that the ECB cut rates, but rates are still higher than pre-2021. Yeah. And obviously CLOs finance highly indebted borrowers with a floating rate loan. So what does it mean for the credit profiles of CLOs?
Yeah, even despite the increase in the interest rate since mainly in 2023, the CLO performance has been very strong. For example, compared to last year, indeed, we have seen like further improvement. For example, in 2024, the weighted average rating factor is like 25.2, and as of August this year, it became slightly below 25, slight improvement. And for the CCC bucket, it reduced to 3.6% from 4.6% last year. And in terms of default, it is actually quite limited, less than 1% of the portfolio balance. I think partly helping this is that, first of all, the interest rate has decreased quite a lot from the peak, more than half from the peak, even though it is still higher than the historical low. But the refinancing condition has definitely improved compared to last year to this year. And with this improvement, that means that the issuer is more likely to refinance at a lower interest cost and therefore a lower burden. And apart from that, I would attribute partly to manager de-risking strategy. So we have seen manager selling troubled asset, and in this year, in terms of for example, Altis France, which has been widely held in the CLO portfolios, earlier this year, this defaulted asset accounted for has actually 1.1 billion across the entire CLO. And now in August, it has decreased to 650 million. So because of this de-risking strategy, we have seen that the defaulted asset decrease and also CCC asset exposure also decrease as well. But this is not free lunch to sell some troubled asset, especially asset defaulted. Then the manager also has incurred some losses as well. But the losses so far this year is quite low at 0.5% below par, and it's definitely below our rating case assumption. So I guess another trend that I want to highlight is that we touch about the credit quality, and the portfolio spread is also something quite interesting because we have seen the loan repricing, and because the loan margin has compressed, and indeed the weighted average spread, which is part of the collateral quality test that the manager need to maintain for reinvestment, it actually has come down from 4.2% in the first half of last year to now 3.8%. So therefore, they are actually increasingly closer to the weighted average spread covenant. But despite that, the manager can still move to another example point, another matrix point, if they have, let's say, a buffer in the weighted average recovery or weighted average rating factor. So I would say in summary is that the CLO portfolio performance remains good, and therefore also because of the very healthy break-even default rate cushion for each rating, we also expect stable rating performance as well.
Okay, thank you. Now let's move on to regulation. There was a recent response, I believe, from the European Commission to a query about risk retention rules, and that has challenged at least some market players. So what's the latest on that?
Yeah, indeed. Last month, European Commission, they clarified a question that asked in 2021, a few years ago, and they responded that the use of conditional sale agreement, which has been a very common use of arrangement to achieve the regulatory compliance requirement, they clarified that for this use, it no longer satisfies the regulatory compliance requirement. Specifically, it is related to the retention holder, whether they qualify as originator under this regulation. So the use of the conditional sale agreement is that the retention holder as the originator, they will sell this asset to the issuer, but then this asset has never been settled with the originator. So it will just settle directly with the issuer. So only if this asset defaulted, then these defaulted asset will be purchased back by the retention holder. So therefore, from the commission point of view, the asset has never really been owned by the retention holder. So because of that, there's no actually like a lot of guidance after that, apart from that the regulation, it doesn't work this one. So end up the manager will have to consult the law firm and to come up the best way to tackle this issue. So far today, we have observed that they use this forward sale agreement in which the retention holder, they will first purchase the asset before the transaction close. And then in this agreement, the issuer will agree to purchase this asset from this retention holder, subject to a seasoning period of like at least 15 days so far. That is what we observe. And if there's no default, then the asset will be then sold from the retention holder, which therefore qualify as originator to the issuer. So I believe that it seems that this should work, and the legal counsel also confirmed that this should be compliant with the regulation. So I guess the next question is like as to the existing CLO transaction, then what happened? And there's like not much guidance, again, not much clarification. And I believe that it will be helpful for the market participant, for investor, and for everyone that for the commission or the regulator to clarify, provide more guidance to clarify about this regulatory requirement, what happened to the existing CLO if they are no longer compliant.
Thank you, Kate, for joining us today. And if you have any questions or would like to continue the discussion, please send us a note to the address on the screen. Thanks for watching.